What do London City Airport, Brussels Airport, and all of these airports have in common?
They're airports.
They're all owned by the Ontario Teachers' Pension Plan, one of the largest pension funds in Canada, and proud owner of the inconveniently placed construction site behind me. But it's not just the OTPP doing this, and it's definitely not limited to 7 airports. Look around and you'll notice that pension funds own chunks of London Heathrow, the Eurostar, and all of Toronto's Eaton Centre. So what makes airports and infrastructure such attractive investments? And how much longer will this last? We'll talk about all that and more in this video. The short answer is that infrastructure generates decent returns with a lot of stability. Kind of like the Cardinals. They're usually over 500, but that's about it.
Hit 'em.
To better understand what's actually going on, we'll first take a closer look at these pension funds, then look at the characteristics of infrastructure, and finally see how things are changing. At the end of the day, all investment funds are trying to do the same thing. Pull together people's money, invest it, and hopefully turn that into more money. Where they differ is usually by their investment goals, since that dictates what's attractive and what's not. Pension funds have a very clear goal: pay people their pensions when they retire. They do this by taking money out of paychecks, investing it somewhere, and hopefully generating enough income from those investments to pay people after they retire. These liabilities are inherently multi-generational, and if they mess up, people lose their livelihoods. With these goals in mind, you can probably guess that pension funds are looking for investments with predictable, long-term cash flows, alongside high barriers to entry and some sort of inflation protection. I wish I had more inflation protection. Some funds don't even build in exit assumptions into their modeling, implying an expectation to hold infrastructure indefinitely. These goals are very different from those of, say, sovereign wealth funds, which usually invest the country's surplus money in line with strategic goals, like China managing their foreign currency reserves or Saudi Arabia exercising soft power in Iraq. Both are then different from hedge funds or private equity firms, which usually just try and make the most amount of money in the least amount of time, adhering to the rule of law only when convenient. One thing that none of these funds are supposed to do, though, is lose money. So naturally, a lot of them did just that in spectacular fashion with WeWork. Which brings us to why airports and infrastructure are such attractive investments. They're pretty much the opposite of WeWork. Infrastructure investments have 3 key attributes, because the rule of 3 is the first thing they teach you in consulting. First off, resilient returns. Infrastructure has remarkably high natural and regulatory barriers to entry, largely owing to insanely high capital requirements, economies of scale, and the fact that people will die if these things aren't regulated. These barriers protect financial returns by discouraging competition. I mean, there's a reason why no startup has tried to build tunnels yet. Now add in very low correlation to other asset classes, and you have an investment with little competition and isn't tied to volatile market cycles either, generally leading to steady and predictable returns. Our second attribute is inflation protection. Direct infrastructure investment means buying part of a tangible asset, something real that you can touch, unlike the other 90% of modern finance.
They peaked at over $450.
This helps infrastructure retain value through periods of high inflation, even more so when you consider the relatively inelastic demand of things like water treatment plants, power stations, and airports. To top things off, many long-term infrastructure contracts, especially with public agencies, have built-in contractual guardrails against inflation. These characteristics have given infrastructure some impressive performance through environments with low growth and high inflation, outperforming equities, fixed income, and real estate since 2001. And our third attribute, the ability to drive real outcomes. Like I said, infrastructure is something you can touch. It changes our built environment and the way we live, for better or worse. Few investments can claim this kind of direct impact. And no, your $10 million Series A for a note-taking app isn't actually changing the world. It might sound cheesy, but for investors who aren't satisfied with just predicting the future, infrastructure gives them a chance to build it. You've probably noticed that these attributes match what pension funds are looking for: stable cash flows with inflation protection and the potential for long-term growth. Going one step further, a long-term investment focus is arguably the perfect complement to the long time horizons needed to plan, build, and operate good infrastructure. While a hedge fund might manage their investments to maximize returns in 3 years, not caring what happens afterwards, It's in a pension fund's best interest to make sure their investments are built to succeed in the long run. I go way more in depth on transit-specific investing in my previous video, so check it out if you like this kind of stuff. There's a link in the description. I was also inspired by one of your comments on public-public partnerships, so I'm planning to make a follow-up video on how investment funds can actually support the creation of high-quality transit systems. Subscribe now if you don't want to miss that. But not all is created equal. Infrastructure investments themselves fall under 3 categories: Supercore, Core, and Core Plus. These categories matter because where an asset falls under influences how it's handled, and also tells us why airports are so loved. Supercore investments are low risk, low reward. Old school utilities are a great example. Everything about these assets, from pricing to production volumes, is heavily regulated, so you have a pretty good idea of what to expect in terms of financial returns. Core investments are still stable, but aren't regulated to the degree of utilities and therefore don't bring the same level of certainty. There's typically an element of demand-side risk, with assets like highways, toll roads, and airports falling under this category. Finally, Core Plus investments are anything riskier. Things like data centers, fiber optic cables, and increasingly infrastructure-related software. The funny thing is, nobody knows for sure which bucket something actually belongs to. A lot of assets that used to be super core are turning out to be a little more risky than initially imagined. The energy transition is a big driver behind this shift. Oil and gas could, and probably should, be phased out within my lifetime, which would make a lot of the infrastructure supporting that industry, like pipelines, essentially worthless. Advancements in energy, mobility, and technology have forced investors to make tough reassessments of their infrastructure portfolios. Nothing is guaranteed anymore, from EVs potentially making gas stations obsolete, to grid infrastructure not having the right inverters to handle renewable sources. Airports are unique in that they don't seem to be going anywhere. Aviation moves at a glacial pace, and it seems impossible that we'll either 1. Stop flying, or 2. Use anything other than an airport when we do fly, at least not anytime soon. Of course, nobody believed in EVs until we actually got them, so maybe this take will age like milk. When you think about the future of aviation, chances are it still involves airports. Electric or hydrogen aircraft still need them, while the smaller eVTOLs, or flying taxis that don't, aren't replacing commercial flights. Of course, if we actually got our act together and built high-speed rail, that might put a dent in things, but there'll still be plenty of transcon and international travel demand to go around. Airports also have multiple revenue streams, from flight operations to retail leases, and charging you $20 for a pretzel. Their sheer land footprint creates intriguing upside for alternative uses, with energy production and even commercial real estate development being options. This last point provides some sort of protection against an unforeseen decline in aviation, since investors will still own a ton of real estate if that happens. If you take a step back, infrastructure as an entire asset class has become a bastion of certainty in an uncertain world, even with the recent reshuffling of asset subcategories. That's led to increased attention from all sorts of funds. BlackRock just raised $4.5 billion last year for a new infrastructure fund with targets of $7.5 billion overall. Back in 2021, infrastructure and natural resources set all-time highs, with global assets under management breaking $1 trillion for the first time. The flip side of this attention is that competition for assets is increasing, making those stable, lucrative assets harder to find. Return expectations on infrastructure have already decreased some 20 to 40% over the past decade. Some investors are therefore turning away from expensive brownfield assets, ones that are already generating stable cash flows like a fully mature power plant, in favor of greenfield opportunities, referring to infrastructure that doesn't exist yet, like literally an empty green field. They then actively build, plan, and operate infrastructure, like Quebec's CDPQ pension fund infamously creating Montreal's REM metro system. If there's one thing that I want you to take away from this video, it's definitely not any specific detail on what makes something core versus core plus. It's honestly not even what makes infrastructure an attractive investment. It's the fact that infrastructure is an investment in the first place. Anytime you use a bridge or an airport or even take the train, that thing doesn't exist just as a bridge, airport, or train. It exists as an asset, built by someone looking to make money and make return on their investment. This is the fundamental truth that dictates what gets built, how it gets built, when it gets built, all that stuff. The sooner we understand this concept, the sooner we can start taking advantage of situations where incentives align. Having pension funds with their ultra-long time horizons invest in infrastructure, which also takes a long time to see returns, might just give us the best of both worlds. I'll save that for another video.
Welcome to King Taps, where prime investment deals are made.